Hi, I'm Tim Romero, the head of Google for Startups Japan, and I'd like to welcome you to Startup Survival and Funding, an APAC VC perspective. Now, we've got 5 amazing VCs from around Asia to talk about how COVID-19 is affecting startups and venture capital in their region. So what's the same, what's different, and more importantly, what startups need to know to survive and even thrive during this COVID crisis. So not only what's going on right now, but how things might play out as these lockdowns end and the world starts to return to normal. So first, we're going to hear 3 deep dives into the current state of venture capital in 3 different APAC countries. Then we're going to be joined by 2 more VCs, and we'll sit down as a group and dig into the details together. We'll cover some of the questions you asked in advance, and you'll get a chance to ask our panelists live questions, which is pretty cool. But before we get started, there's a few things I want to let you know. So first, this whole session is being recorded, and we'll be sharing it later. So if you have to leave in the middle, you can come back and pick up where you left off. Or, if you get a lot out of this session and you want to share it with a friend, that'd be great too. Second, please use this URL to check in and let us know you're here. And don't worry, you don't have to type all that out. One of my team members should be posting a link in the YouTube live chat right about now. So just click on that link when you see it and let us know you're here. Third, and finally, while you're checking in, I want to let you know how you can ask questions from our speakers. It's pretty simple, really. You just post them in the comments section as you think of them, and be sure to put your name and country before the question. So for example, in my case, I type in Tim, Japan, and then ask my question. All right, that is definitely enough for me right now. So I'd like to introduce our first speaker. Yusen Dai is a partner at Zen Fund and is a startup founder himself. He dropped out of Stanford to co-fund Jumei, which is one of China's largest e-commerce companies, and IPO'd in New York. So let's welcome Yusen on stage.
Hey, thank you, Tim. So good morning, everyone, and thanks Google for inviting me to this online sharing session. So first, let me give you a brief introduction of Zen Fund. So next slide, please. So we are founded 9 years ago, and we are the leading and arguably the best angel investment VCs in China. Currently, we have 3 offices in China: Shanghai, Beijing, and Shenzhen, managing over $1 billion AUM, and have 700 portfolios, 25 unicorns, and 7 IPOs at this time. So next, please. And we just closed our new USD fund 6 before Chinese New Year. So it's a $250 million fund. So probably we are the largest angel fund in the world dedicated to only angel investments. And given the situation of COVID-19, we still invested in 10 plus new deals in 2020. So I think that is uninfluenced by the pandemic. Our investment philosophy is quite unique, that we are only founder-centric. So many funds look forward, try to predict the future after COVID-19. So while we look backward, so we only consider the quality of founders and the best founders we identify in the market. So this strategy is less affected by the pandemic. And we do all the angel investments in all sectors and in different countries like US, also Southeast Asia, or even Middle East Asia. So basically, we're known for our founder-friendly terms and fast decision processes, so which also stayed the same during the pandemic. So I would happy to say that our fund worked pretty much as the same during the last few months. So next slide, please. So speaking of the COVID-19 impact in China, so first, that is a public health crisis, and the Chinese government, I think, handled the crisis extremely well by putting strict travel ban and effective tests and treatments. So I bet you that you have read a lot of articles about the influence of COVID-19. So I just want to point out several industries that we see long-term behavior changes during the pandemic. So first, the shelter-in-place policy is a huge boost to online education and enterprise communication and the collaboration industry. So all the schools and companies that are required to have online sessions, and the infrastructure was there before the pandemic, and the customer behaviors are reinforced during the last several months. So we see that is likely to continue after the travel ban has been lifted, as the schools, they are also still having their online sessions, and the user behavior has been built up. So the best proof is that we are having these sessions today online, while previously it's quite rare, right? And many celebrities actually joined the live streaming e-commerces, as the movie and the TV show businesses are completely shut down. So they basically find live streaming is a way to keep their popularity, and then people have more spare time to watch live streamings and shop on e-commerce, since they cannot go to offline anymore. So that is a huge boost to platforms such as Taobao, Kuaishou, and TikTok. And we see that is really a cross-cutting event for the live streaming to the mainstream market. Also, we see several new grocery delivering companies grow very fast, since restaurants and supermarkets were closed and people need to buy groceries online. That is also a new trend. I think that finally, 20 years after web ban, we in China, in the first tier cities, the online grocery shopping things finally boomed. And we see the so-called new infrastructure development is a huge tailwind that is consists of 7 high-tech sectors where the Chinese government aim to invest heavily in next 10 years. So that included 5G, AI, big data, industrial internet, etc. And we also have some observations. First is that there is no significant retaliatory consumption so far, so-called. The spendings are back, but we see normal levels, so no like super surplus spendings. And the big companies tend to consolidate small players, given their larger balance sheet and better cash reserve. So actually, that is an opportunity for them. And people adopted online collaboration in a very fast pace. So before the pandemic, the technology and the infrastructure was there, but it's also still very hard for companies and organizations to shift to remote work. And now I think a lot of our colleagues and friends think, hey, the remote work actually works, and we don't need that much space, office spaces, and we don't need that much offline meetings. I think this behavior change is very significant, and that is the first time in human history that so many organizations and the people work remotely, and I think that is actually very effective and efficient. So next, please. And I would like also share some observations about the Chinese VC industry. So the top tier US funds in China still have plenty of dry powders to invest in new deals, as I think many funds raised their biggest fund during the last 2 years. But they also agree that the valuation is definitely high before the pandemic. So many of them want to wait to buy the dip both from the primary market and to secondary market. And the startup competition is harder and harder because the environment is with more uncertainties and the technology innovation cycle going into the late stage. So the bar for new investments becomes higher too. That also creates consolidation to the top deals in the market, that they can still raise tons of money with very good valuation, while at the same time, mediocre deals receive much less fundings than 2 or 3 years ago. And the VC looks more at the business models viability versus growth speed now, as many models innovations such as O2O, P2P, or Luckin Coffee busted in the previous two or 3 years. So now investors pay more attention to sustainable unit economy and positive cash flow. And the valuation generally becomes more reasonable. So we see many flat or even down round happen, but still the competition for hot deals are still very, very intense. So so next, please. So as a founder before, I will share some advice for startup survival. So I co-founded Jume into online. So that's in the aftermath of financial crisis. We raised only $200,000 for our angel round. That is also by joint fund. So we went to the completely pivot during the winter for our business model. And we went to public in 5 years, sorry. So I think I can think about some advices that reminds me of what we did 10 years ago. So I think for now, fundraising, speed is everything. So make sure that you talk to existing investors and the ones that are already familiar with you guys first to save time. and don't insist too much on valuation, as if that's necessary. Flat or down round is okay. And when you talk to VC, be sure to ask about your current fund investment strategies, their remaining dry powders, and also the decision process, right? And check, did they do any new deals recently? I mean, for now, I think as the difficulty to do due diligence and to do travel, so many decision processes in VCs, especially in later stage, are delayed. So make sure to check about that. And if your burn rate is still high, do try to reduce burn rate before fundraising, as to show that you are able to control the bleeding. And for the business part, you should definitely target 12 plus months runway. So if you don't have that yet, so you need to cut all non-essential costs and necessary job cut. And don't be too optimistic. And I think the behavioral change will may be longer than what we expect. And the VC fundraising environment will get to the normal level like slowly. So don't be too optimistic. And if you need to pivot, do that early so you have the maneuver ability to do. And think about new opportunities creatively. So 10 years ago, when we start our startup, it was a advertisement platform in social games. And then during the winter, we pivoted to sell cosmetics and became the largest cosmetics e-commerce in China. So that is a very totally different pivot. And we see that quite often in the startup world. So if you want to do that, you can think all kinds of new opportunities that you see during the way. And if you want to do the pivot, do that decisively. Since abandoning the new business, the old business is suffering, but that is like necessary evil to survive sometimes. So don't look back, just look forward. And also very important to identify core team members and keep their morale high, at least keep them busy, right? But also do not hesitate to necessary job cut. The sooner you did the job cut, I think the better to save the company. And finally, I should say, be ultimately optimistic. So it has been observed that the best startups tend to be founded during winters because there are less competition, and there are spring following the winters, right? As the startup funding and the innovation is always a cycle. It's always a repeated cycle. So do hang in there, keep calm, and carry on. So thank you for your time. I think let me move. That's the end of my presentation.
Thanks so much, Yusen. I love the fact that you're not trying to predict the future trends and you're focusing on founders. That must give you a lot of clarity in like uncertain times.
See you soon. Yeah, definitely.
Okay, thanks so much.
Thank you.
I'd like to introduce our next speaker, Han Kim, who's the managing director and co-founder of Altos Ventures, which he started back in 1996 in Silicon Valley. And he's been investing in high growth tech startups in both the US and Korea ever since. In fact, he was an early backer in some of Korea's biggest unicorns. And we're delighted to have him here today. So thanks for coming, Han.
Thank you for having me. Let me first start out with a brief introduction of Altos Ventures and then talk about what we're doing in Korea and how we're thinking about the current crisis. First, a bit on Altos Ventures. We're an early stage venture fund with offices in Menlo Park and Seoul. We're a little different than a typical venture fund in that we like to accumulate incredibly large positions in few companies over a long period of time. So as a result, since we're SEC registered, our regulated assets under management is now well over 3 billion. And most of that is concentrated in our top 5 companies. So we invest roughly about 100 million per year each in Korea/North Asian region and also in the US. And we will continue to do that thanks to great investors that have been with us for a long time. And just recently, we just closed a new fund in April, a $350 million fund dedicated more or less towards Korea plus countries in Asia. In our Korean investment efforts, we started to invest back in 2006, but it was a very sporadic effort Starting in 2014, we started to add 6 to 10 new companies every year, and we've been fairly consistent in terms of the number of the companies. And over time, good things happen, and we have now 2 companies at well over $1 billion revenue run rate, 3 at well over $100 million run rate, approaching $1 billion. And we got a bunch more that's growing. What's amazing about Korea for us is that most of these companies that are, as soon as they hit close to a $50, $60 million revenue run rate, they are cash flow positive. And so we worry less as, compared to some of the companies in the US. It's you have to wait till they get to a several $100 million revenue run rate before they turn cash flow positive. When COVID crisis hit, what we did as a partnership was we divided all the companies into 2 sectors. One is basically green sector, which is mostly online games, commerce, food delivery, social apps, fintech, the ones that require very little physical interaction. And then red sectors, which are travel, physical retail, the kind of businesses that require personal, like in real-time personal interactions. And obviously green sectors, we had a different approach from the red sectors. Our assumption was that things will get even worse before getting better. And I think when people realize some of the changes will become permanent, we think there might be more panic down the road. And that's why we think the things will get worse before getting better. So we wanted to prepare both sectors for basically under the assumption that our assumption will come true. So in terms of the companies in green sectors, we are encouraging them to hire key people very quickly, be aggressive. And if there's a chance to raise more funding, let's go for it. So seek some, interesting M&A opportunities. And at the same time, we're advising them to stay very quiet, telling the press, telling the world how well you're doing. Just because, whenever you're doing really well during, when everyone else is hurting, it's usually, you invite some government scrutiny, etc. In terms of the companies that are in the red sectors, the companies that are really hurting, what we are telling them to do is, let's just assume that we're going to have 2 years of little or zero revenue. And let's just work backwards. Let's make sure we have the runway to last 2 years, with that revenue assumption. And if we need to get a funding round done in order to make that happen, whether it's down round or less than if the price is less than what you had hoped for, let's bear with it. Let's get it done, even though you think that things might turn better. So let's expect the worst, get it done. That way you don't have to worry for the next 2 years. And so what some of the companies under our advice did was, some of the executives, they cut their own salaries. Some executives cut salaries to zero before they let go of people. And, for a lot of the CEOs, it was their first time having to let go a bunch of people that they worked so hard to recruit into. And that was a painful process for a lot of the CEOs, and I think they're going to learn quite a bit from it. And some companies had to take massively dilutive rounds in order to survive, and some companies, I don't think will make it. And that's the way I think things turn out. In terms of what we did in 2020, as in Korea, as you know, the meetings are still being done in person rather than over the Zoom, like in the US. So one of the things I wonder is if we had to go to virtual Zoom meetings from start to finish, whether or not the Korea office will be able to adjust, because that's just not the way we have been doing, we have been investing in companies. And thank God that we're able to do meetings in person now. To be perfectly honest, we have been very slow adding new companies this year. We only added 3 new companies to date. So we're, more or less on pace, but slightly under sort of our normal pace. Probably 1 or 2 companies under our normal pace. But we've been more or less aggressive funding our own companies. So, we're in midst of finalizing 10 million plus investments in 2 companies, 30 million plus investments into 2 additional companies. And a couple of these companies, they were in the red category. A couple of these companies were in the green category. So, we are working on both sides, the good ones, the ones that are benefiting from this crisis, and the ones that are actually hurting from this crisis. And, we're going to bat on both. One of the topics that was raised around valuations, I think we have seen some adjustments in valuations, and I think, some are good, and it's necessary to get some adjustments in so that company is better positioned for later financings. Nothing is worse than doing a small round of financing at high valuation, being stuck at that valuation and running out of money. So we make sure, we advise our companies to never get into that situation. But also at the same time, we're not trying to take advantage of the situation to look for, sort of the bottom fishing type of valuation, because a lot of times when you really try to bottom fish, it just forever ruins the firm's reputation. So we're trying to keep the valuation at a very reasonable level for everyone to be equally happy and equally unhappy. And, part of our assumption is that only if the company does great that we do well. So, just, getting another 20% off on the valuation, I don't think it does anything to, venture fund returns as well. So those are some of the things that experiences that we have gone through. So that concludes sort of my talk, and thank you for hearing me out.
Hi, Han. Thanks so much. That was some really good and really specific advice for startups. I'm looking forward to bouncing some ideas off you in our panel discussion later, but thank you so much for that.
Thank you.
So our next and final speaker for today, before we get to the panel discussion, is Alan Hellowell, who's a partner at Alpha JWC Ventures. Now, Alan's been deeply involved in the Asian internet and e-commerce markets since 1995, and he's got experience in both investing and M&A and IPO throughout Southeast Asia. And today he's going to be talking about his insight into what startups in those markets need to know about COVID-19. So thanks for joining us, Alan. Alan, I think you're on mute. Can you?
I'm awfully sorry, Tim.
There we go. Take it away.
Thank you so much for the introduction. Alpha JWC is one of Indonesia's largest venture capital firms. We focus largely on seed stage and A round investment. We have roughly $175 million under management. Very much appreciate the opportunity to join you all today. I think we all admire all of the noble efforts that have been made to try to assess and tackle the issues that we face. Given all of this good work, I personally wanted to dispense with the pleasantries and the generalities and the "we'll get through this together" type comments, and instead bring to bear my own perspectives. And hence the title of this slide, From Alarmist to Auspicious, Perspective is Everything. With the top of the slide, I present the tops down view, which we're all very well versed in. It's on the alarmist side of the spectrum. The ADB, for instance, cut Southeast Asia 2020 GDP growth from 5.5% as of September of last year to a mere 1% as of April or last month. And it wouldn't surprise me if that gets reduced further. The IMF, meanwhile, is expecting Southeast Asia's 5 largest economies to collectively contract around 1.3% this year. And we all are familiar, as earlier speakers have referenced, with the offline industries that have been absolutely pummeled by the pandemic. I indeed wanted to share my own perspective, which I try to capture in the bottom half of this slide. I call it the left to right perspective. I'm looking at the broader spectrum in which venture capital sits, which indeed begins with the founding of a startup, or what I call the seed stage, left side of the graphic, and evolves through subsequent stages of the fundraising and capital markets activities all the way through the IPO. This view I've cultivated through 15 or 16 years as an investment banking analyst, having done a number of IPOs out of China, and most recently as chief strategy officer in helping lead Southeast Asia's first internet IPO, being C Group, onto the New York Stock Exchange in October of 2017. And lo and behold, the green background of that graphic on the left is C Group's share price, which yesterday hit an all-time high. A bit odd if you think about the overall conditions that have beset the industry. But C Group, as the lone representative of the Southeast Asian internet economy in the public markets, I would argue is a very accurate bellwether. It stands in 2 of the 3 largest parts of the internet economy, which we'll discuss shortly. And it's not just C Group that is experiencing this newfound fame and market cap. If you look at the share price of our good host today, Google, it's recovering very rapidly toward its 52-week high. Meanwhile, Facebook just punched through its 52-week high. And so you really would not think that we're grappling with a lot of the issues that we're here to discuss. I think one of the challenges is the private markets have enjoyed, particularly in my part of the world, Southeast Asia, a period of incredibly heady growth with ample capital driving valuations up to levels that we haven't seen ever. And we're having to grapple with that. But having practiced most of my career in the public markets, I'm here to say that the capital markets are still functioning soundly, and that while there might be some speed bumps at the seed and A round, we can rest assured in my mind that category winners will continue on their merry way, clearly having to pivot here and there, but becoming all the stronger as a result. If we could move to the next slide. Again, having spent most of my career in equity research and analysis, I'm a big fan of the just sticking with the facts, ma'am approach. And I thus wanted to navigate our findings around the largest and most representative parts of the internet economy. And as you'll see with this pie chart, e-commerce is roughly 40% of the value of Southeast Asia's internet economy, followed by gaming and entertainment and finance. And so if you don't mind indulging me with the next slide, I'd like to share with you the results, basically the culmination of a joint study we undertook with a leading internet platform and several fellow VCs in the Southeast Asia region, with the table I'll be presenting over the next 3 slides. And I assume most of us on the call would agree that there are clear winners in the COVID-19 era, which I present on this first slide, namely e-commerce, gaming, health tech, edutech, food delivery. And so there's not a lot of controversy there. But what I would say is absent in this specific slide is a segment that I can't really capture as a sector, but might be best designated as a megatrend, and that is O2O, or offline to online. And it includes segments such as the last line of this table, food delivery. It's an area that we find amongst the most exciting and dynamic in its pivoting in response to the COVID-19 pandemic. In fact, one of our portfolio companies, Kopi Kenangan, which is Indonesia's largest grab-and-go coffee chain, just finished a $109 million fundraise, largely because it has found fascinating and very ingenious ways to address the challenges of the consumer, leveraging largely elements such as the food delivery network, which we know has been repurposed and has seen a reinvigorated role here. And so with that, I'd like to go on to the next slide, which really presents the second or middle segment of our study. And it covers segments which I believe have been at least moderately positively impacted by the pandemic. Interestingly, many of these categories rely more on driving new behavioral change, at least in Southeast Asia. These behaviors may be well established in markets such as North America and China. But in the case of, for instance, media, we're not entirely sure if people are going to pay subscriptions for online video or music or even podcasting. With the next category, digital insurance, markets in Indonesia, frankly, do not have a long tradition of buying insurance. And so right now, these categories all rely on leaders in the space spending the current period educating users and trying to drive behaviors, sustainable behaviors, which we're confident we'll see, but is not a given. So if we go to the next slide, again, I assume most of our listeners today would agree with the sectors on this slide whose businesses have been challenged by the pandemic. But I wanted to instead maybe draw your attention to the second right-hand column, the midterm. This is where all of us have shifted our attention. And we at Alpha JWC have been privileged to have invested in a number of very nimble companies that have successfully modified their business plans to service changes in their customer needs. And one such example is a company called Gudang Ada, Gudang meaning warehouse in Bahasa Indonesia. It's a B2B marketplace, which almost on a daily basis is conferring with the wholesalers and retailers on its network to determine what incremental pain points they're experiencing and how the app and the back end should be changed to ease that pain or even short circuit it through automation. And so we're hoping that more and more of these marketplaces continue to solve problems in this crucial period. And I think that many of them will find that those innovations are sustainable for the long term. If we move on to the next slide, with this slide, I simply wanted to offer a forest from the trees perspective. And that is the long-standing and I think sustainable profitability of the internet leaders in our part of the world. You have Alibaba, Tencent, and Baidu, companies that I personally have spent 15 years supporting through IPO and as public companies. And as you can see, boasting generally very sound gross profit margins in the 40% range and EBITDA margins that begin at 30%, and in the case of Alibaba, go into the low 60% range. There might be some slight perturbations in the margin profiles of these companies. But again, if we think about the market holistically, Alibaba in e-commerce, Tencent in social, Baidu largely in search and AI, I have reason to believe that these levels, profitability levels, are sustainable. If we go to the next slide, we're starting to see they're not even green shoots. They're just continuations of growth that we saw before the pandemic. And bringing the discussion down back to my yard, namely Indonesia, Indonesian e-commerce fundamentals remain very sound. Remember, e-commerce is roughly 40% of the internet economy. In this case, we again take the market leader Shopee Its GMB, as it just announced earlier this week, jumped something like 76% for the region, probably 100% for Indonesia alone. And its critical take rate continues to churn upward. If we look at slide 8, we believe that a lot of the business models, sorry, can we advance the slide? Yeah. That the take rates, not just of Shopee and Tokopedia and e-commerce, but of the other marketplaces, have a tremendous amount of upside. If we think about the global peers, those take rates are bounded by Alibaba in the 4 to 5% range and go up to Amazon's third-party marketplace at about 25%. And if we go to my final slide, clearly I've revealed myself to be an optimist in this challenging environment. And there's not much I can add to the fantastic insights and analysis that earlier speakers have shared. But I wanted to make the very simple point that great companies grow through both bull and bear cycles. Some of the next unicorns and decacorns are, I'm convinced, being founded as we speak. And so I think, although we're taking our knocks right now, we're at the very beginning of another bull run that hopefully will involve even more robust companies that have even more learnings underneath their belt. And with that, I'd like to pass the microphone back to Tim. Thank you very much.
Thanks, Alan. I really like the deep dive into the different industries and how it's being affected. And I'm looking forward to talking more about that in just a few minutes. So thanks for that info. Now, before I bring back our speakers for our panel discussion, I'd like to introduce two more amazing VCs who are going to help us round out this panel. So first, Harsha Kumar, who's a partner at Lightspeed, where she focuses on consumer, SME, and fintech with a strong base in the Indian markets. And before Lightspeed, she worked at several hyper-growth startups, including Ola and Zenga. So welcome to the panel. And do you want to say a few words, just introduce yourself?
Thank you so much, Tim. And thank you for the opportunity. Yeah, quickly to introduce Lightspeed, I'm guessing maybe a lot of the guests don't know a lot about the fund. We're basically a global fund investing in India, Southeast Asia, China, Israel, and of course the US. Early investors in companies like Snapchat, Cameo, and in India in companies like Oyo Rooms and Byju's.
Great. And our second new panelist is Ken Yasunaga. And Ken's been the director of the Venture Capital Association of Japan and the managing director of the Innovation Network Corporation of Japan, one of the first and largest public-private investment partnerships in Japan. And Ken, you've actually recently moved over onto the startup side of the table and are now CFO at Floatia. And thanks for joining us. And do you want to add something to that, kind of round out your
Sure. Well, thank you, Tim. Thank you for the introductions. And I'm honored to be here and speaking with a great panelist. And, I'm currently working with the semiconductor company called Floatia. I'm in the midst of the raising money for this company. So, and before that, this INCJ is a government fund with a $20 billion under management. So it was a big change, but I'm really enjoying this ventures.
Great. We're delighted to have you here. So I'd like to invite all of our speakers to join us back here on stage, and we can get started. So actually, the first question, I want to talk a bit about startup strategies and how startups can survive. And Ken, I think you're in a really unique position in that you've had years of experience as a VC, and now you're at a startup who's trying to raise money. So what advice do you have for startups who are in that situation right now?
Yeah, I think it's it's many things. I think you and everybody has given a great advice. So basically, it's how to keep your cash in, and also you need to change some business model if it's necessary. And this event will be over sooner or later, so be patient and so on. So additional thing that I can add, couple things that I can add is, if you want to do some restructuring, you can do it just once. I mean, let's try to avoid some, continuous restructuring, continuous, firing of the people. You have to, I sometimes raise salary for a certain employee and for the person that I want to keep. So mindful of the focus on one side, and the other one is, if you have a luxury, you want to be very selective. It's also the time. Of course, a VC can judge about you, but we can also judge about the VCs. There's a lot of VC and who will not support the existing portfolio company. So if you can ask the question to the VC, okay, what's you doing with the current portfolio? If they are like really helping those startup portfolio company, that's the people you want to go. And there's a company that you just stole any of the new investment or the follow-on investment. I wouldn't recommend. If only you have a choice, I wouldn't recommend to talking to them.
I think that's something that a lot of startups are probably feeling like it's a buyer's market now, and that they can't be too selective about, they can't be too choosy about where their investments are coming from. Harsha, I'm curious, in India, is that dynamic still in play? Are startups, can they still afford to be choosy about VCs, or is the pendulum kind of swinging the other direction?
Yeah, I mean, not just in India, but I think in pretty much every market, this is wartime. And, by the way, you have to pardon me for background noise. This is early morning in India, so you're going to hear a lot of that. But this is wartime, and essentially, everything you can do right now, you can basically put it in two buckets, right? It's either about its survival, number one, and then once you've figured out how to survive, you think about flourishing. And under survival is really, it's about increasing your cash runway, and it's about finding sort of other ways to make more cash available to your company. And that can come from multiple sources. This is not the time to be choosy. This is the time to sort of think more practically about how you would increase runway.
Actually, let's dig into that, because that's something that a lot of you guys touched on at various points. So I think a lot of startups have the sense that, they feel the urgency to reduce their burn, to extend their runway, but how to do that? And I think there's a lot of differences between markets. So, for example, Han mentioned that companies should be very slow to cut staff, and that relationship is very important. But it might be very different in other markets. So actually, Alan, let me ask you, because you work across Southeast Asia. What do you think are some things that startups should stop doing in order to lengthen their runway, and what are some things that you think startups should maybe start doing to lengthen that runway?
Well, I think some of the other panelists have hit on a couple of the do's and don'ts. I believe that there is a pervasive exercise that applies to some of those good points, but it's even broader. It's a broader activity, and that is kind of forgiving your previous business plans and the ambitions baked into them, and really aiming for something that may well come nowhere near your original P&L goals, and may even represent a year-on-year decline. Because I think it's easy to give lip service to the idea about becoming a little more conservative when you have your board meetings, but actually allowing it to fully osmose through the organization, I find is a little more elusive to particularly the more ambitious entrepreneur. So basically, literally coming to grips with the idea of a slowdown, of missing targets, et cetera, and aiming for, from a certain perspective, a more mediocre result, which may well ultimately, mediocrity may save you and the fate of your company. The other thing that we've seen here in Southeast Asia, remember that unlike I think even India, VC has no more than 10 years of history here. We have not gone through any downturn. And all of the leading lights of the VC space, with the exception of maybe Sequoia, which is an eternal global name, have not encountered this environment. And so some of the advice I give to my entrepreneurs and my peers in VC are to, in the past 5 years of white hot growth, the founder could be forgiven for not paying constant attention to things such as culture and cohesion. Now that people are sitting at home with a little more time on their hands, it's a great time to be building the team, to be bearing your soul, to be cultivating that culture. Because in my previous life covering the Chinese internet space, we saw growth, everything going up and to the right. And then when the music stopped, those companies that happened to be in the right place at the right time and ended up really encountering more existential issues than those companies that constantly refreshed culture, went into a lot of team building.
A really interesting point. I think that a lot of startups have kind of realized that a little too late, and they're trying to build culture at the same time that they're distributed, and it's a lot of work. Hey, one thing, and I just want to see a show of hands, because I've noticed one theme that seems to be running through everyone's comments, and that seems to be that looking at COVID, all startup founders need to rip off the Band-Aid. If there's going to be changes to be made, it's better to make it first, make it early, and make it fast rather than to wait and see what happens. Just show of hands, am I reading that right? Is that your advice, or do you see it differently? So a mix. Okay. Alan, you think it's better to kind of wait and see what happens?
I'll put it this way. I mean, we're in almost daily discussions with our founders. I do believe that there is a time for very significant transitions and reductions. But I do think that things are moving so quickly in a lot of the sectors that we've invested in that there is some space for incremental pivoting and transition. But I do see utility in making some decisive movements.
Okay. And Han, you gave some really specific advice on this, but there's one thing I do want to kind of hone in on, because I think it's something that's really personal and important to a lot of founders. When you talked about how to lay off staff or when to lay off staff, and having the executives take a salary reduction or zero up their salary. Some startups have gone very aggressively. We've seen like Uber and Lyft cut like 25% of their workforce. What advice do you have to founders who are struggling with this? When is the time to pull the trigger and actually consider laying off staff versus, doing whatever you can to keep the team together?
No, I mean, I think, our advice is always, we would rather not get into that situation. However, if you have to do it, we're actually more on the very harsh side. So just put it in a very crude terms. We say, hey, if you need to cut off a few fingers to save your life, forget about fingers. You need to probably think about cutting off both arms, not just one arm, but both arms. Like what Ken said, you don't want to be going back to your employees and say, guys, girls, I'm going to make a second cut. I miscalculated. You only have one shot at doing it. So if you have to do it, think about it. And if you think you need to cut 20%, we advise to go for 40 to 50% and just get it done, one shot, get everyone rounded up. Like, this is the last one and only cut we're going to do, and we're going to come through. And that's why we assume the worst, which is zero revenue for next 2 years. And what do you need to survive? And you get to that level, you make one decisive cut, and then you go from there. And it is gut wrenching, and it should be gut wrenching if if the CEOs are doing these cuts casually, then most likely we're not going to be big supporters of the company afterwards. And we want the CEOs to be able to make these decisive cuts, but they should be crying. They should be so sorry that it had to come.
I'm pretty sure a lot of them are actually right about now. It's yeah. All right, I think that also it echoes what Alan was talking about the importance of having a culture and a team that holds together. And yeah, if you're constantly have that threat of further cuts and further changes looming over everyone, it'll be that much harder to get the remaining team to focus and to execute.
Mm-hmm.
Let me change the question slightly. So let's just as a hypothetical, I don't need you to talk about your specific investment strategies if you don't want to, just in your region. So let's say that this crisis drags on for a few months longer or a year longer than we really expected. The fact is, very few early and growth stage startups have more than 6 to maybe max 9 months of runway. So VCs are also going to have to be making some pretty tough choices. Now, Yusen, I loved your idea of we focus on the founder, we don't try to predict the future. And I guess that would give you a lot of clarity in how you invest. But how do you think investors in China are going to be approaching this tough choices? How are they going to prioritize which of their portfolio companies get follow-on life-saving investments?
I think many funds, especially for the later stage ones, they are doing reorg or life-saving the companies that are in trouble. I think that is a good thing to do, especially consider many difficulties the company facing actually one time, right? So if you have to seize through this opportunity, the team is solid, the business model is good, it's only like one-time problem. But also the COVID-19 exposed the inefficiency of many companies' business model. So if that is the case, I think the investors will be quite hard to do the life saving for their companies. I think that is a test. And I mean, the COVID-19 is a incident, right? It's unpredictable. But before the pandemic, there is already signs that shows previous business model like innovation doesn't work. Like we see on WeWork or like Luckin or like those conceptual companies that don't have a strong business model. So I think the COVID-19 is just a event that triggering those unwinds, but actually the unwind start before the pandemic. Yeah.
All right, yeah, that makes a lot of sense. Harsha, I know the Indian startup ecosystem and VC ecosystem, much like Japan, has just radically transformed itself over the last 10 years. I think a lot of VCs, just as much as startups, are figuring out things as they go along. So how do you think that VCs in India are going to be prioritizing their follow-on?
I think obviously the objective for every VC is to sort of preserve all of their assets or companies, so to speak, right? You want to let them flourish. You want to give them the time to do that. I was just noticing the live comments, and then someone from India commented, "Aren't like VCs in India or VCs globally also screwed? On their returns going to get impacted as well?"
Maybe not that bad, but it's going to be a rough.
This is a tough time. Yeah, it's a tough time for everyone, including VCs. At least I can't talk about other funds. I can speak more to how Lightspeed is thinking about it, really. Some of the things that are working in our favor, fortunately, is because we are a global fund and we invest across stages, right from seed, Series A, all the way to growth. It's been easier relatively for us to support our companies. And, so we're actively thinking about that. And then the other is, a little bit of the exercise that sort of Alan showed in his slides, right? Which is, which of these companies are only seeing near-term impact, but are likely to recover, in the medium term. and you want to give them the time and the runway to get there, and you don't want a speed bump to come in the way of their growth. Having said that, but if there are certain sectors where we see there are going to be long-term impacts, like even if we funded them, the reality is that it might just be difficult for these companies to see the light of the day, like maybe a year down the line. So it's important then in that case to be honest, even if you don't want to do it, that you have to be a little ruthless about the choices you make.
Okay. Hey, listen, I'd like to turn it over to the audience. We've got some really interesting questions coming in now. So some of these I might throw to one of you, or I might just ask for like a show of hands for simple consensus. So Ravish in India asks, if COVID-19 has put recessionary pressures on the whole economy, where do VCs suggest to rationalize startup costs first? Would it be in A, marketing, B, infrastructure, C, software? And I'm going to add a different one option here. D is it's impossible to make general recommendations, but I hate to do this with show of hands, but let's do a show of hands of who would think that the first thing and most important thing to cut back on would be the marketing. 2, 3?
For
3 out of
some,
4,
not for all.
What's that?
For some, but not. There are some companies that are thriving under these conditions, so you don't want to cut off market.
Yeah.
So in just general broad strokes,
yeah,
that's where you cut. Cutting back on infrastructure?
Absolutely. I think that there should be an absolutely trained response to go back to the business complex you're occupying and immediately negotiate for lower rents and just revisit every element of your CapEx plan.
Yeah, that's true. And software expenditures, software development. All right. But actually,
I don't know if this is like software development, but if you're using tools where you can renegotiate costs, that would make sense.
Yeah, I think the general consensus, the answer is look at all of the above. Look at wherever you can make cuts, but the final answer is really going to depend on your unique startup and your strengths and weaknesses.
Yeah, and also to the customer, what if there's anything that makes your customer happy, you should keep spending the money on that. That will lead to the more revenue per customer. Right now, it's very hard time to acquire a new customer, so you want to focus on the existing customer.
Okay. So Stephen from Indonesia says, thanks for sharing. The first order consequences seem to be unanimously agreed by most. What do you think are the second order consequences of COVID-19? And what I think we're getting at here is, so we've seen some reactions, some immediate changes, but long-term, what do you think what will be the real long-term impact of this COVID-19 crisis? How is the world going to change for both startups and VCs? And Ken, let me throw that to you.
Yeah.
I always give you the most difficult questions.
I'm happy to have that. I mean, it depends on whether it's a fundraising and also the business-wise. Business-wise, you can pivot always. So there's always a chance to survive. In terms of fundraising, I'm not, too pessimistic about the fundraising side. Even we have some second wave coming in, because I think that Usain has mentioned the same thing. There's enough dry powder in the market for VC, and all those VC have to do something, have to spend money to get the return to their LPs. So you might hit with the valuations, but they have an obligation to invest money. And quite frankly, when I was VC in the States, some of the deal I made a fortune in some of the restructuring round. So I think that's where the VC, some of the VC makes money on that. So we should take chance on it.
Okay. Well, listen, we're running out of time, and I really want to get each of you to just a quick thought on how we're going to come out of this. So once the economies start coming out from lockdown within your own region, and I know some are much further along than others, but what is the one takeaway that you think is most important for startups to know about how the world will return to normal, or if it won't ever quite return to normal? What should they be looking at as we come out the other side of this COVID crisis? Han, do you want to kick us off?
I mean, it's not that different from any other time. I think we tell each other, every company, hey, let's make sure that you're not dependent on. Let's get to a place where you're not dependent on external sources for funding. We just got to make sure we could generate our own growth without a need for venture investors like us. And we tell them, we love you, we might fund you, but you might not like the price at which we fund you. So if you don't want that, make sure that you have the means to continue to grow at a high rate of speed without needing external funding. And let's just make sure we have enough cash to get
to stand on their own feet.
Yeah.
Alan, some closing thoughts about what startup founders need to know?
Yeah, I think that broadly speaking, we need to shift our perspective, which has underpinned so many of the business plans I've looked at, which are kind of the mouth-watering numbers of places like Indonesia with 270 million in population, and really replace it with the M word, which is monetization, and get the founders, their marketing departments, et cetera, to really possibly shorten that kind of growth of network stage that we see in a lot of these emerging markets, and focus on monetizing, particularly the critical behaviors that have emerged, and specifically as a result of the virus. So we're just trying to really get them to change their thoughts from growth to monetization.
So get the business model fixed, start generating revenue, focus on the revenue, which really is right up with what Han was saying as well.
Right.
Yusen, I know your fund has this real purity of purpose, but what would you tell different startup founders? What's the one kind of closing advice you'd give them?
Sure. I think first is this too shall pass, right? So hanging until the pandemic is over. And as a previous founder, I think my takeaway is founders need to learn to save small money and to put big money to strategies, while a lot of founders, they don't know how to save small money through day-to-day operation, but they are afraid to spend big money to pivot or to do strategic decisions. So to make sure that you are continuously be operating effectively and also be brave enough to do pivot. I think that is my takeaway from my previous startup experiences.
Yeah, I think that's going to be a new skill for a lot of founders to suddenly start focusing on, not so much focusing on growth, but focusing on operational efficiencies.
Sure.
It'll be an important skill eventually. They're just having to learn it sooner in their growth curve.
Yeah.
Ken, it's looking like Japan might emerge later than the rest of Asia from this COVID crisis. What's your advice to Japanese startups or startups in general in how to get through this?
I think, many of the comment I echo with all the other co-panelists. But yeah, if I may add, I think the communication with the existing investor, I think that's very critical. At the end of the day, the last result is existing investor asking them to have some follow-on money or some drastic relationship. Drastic move or drastic people. So be transparent and try to think about what's the problem they face and tell them how they want to maneuver and try to get their opinion. And we are in the same boat, and everybody would agree. I think at this point, the investor relation or communication will be the most important.
That's a really good point. Yeah, because it's the VCs know everyone's in a hard place, and it's not a time to be overly optimistic. Just be frank. Don't hesitate to ask for help.
Right. Exactly. Yeah.
Harsh, do you want to wrap us up with with whatever closing thoughts you have for startups to get through this?
Yeah, I think that, all great advice from everybody. Just another dimension, I guess, to add is, another resource that you have available is actually the entire startup community. And that's something that at least we're trying very actively to almost, promote, is to work with other startups in the ecosystem. While you're letting go of people, there are others that are looking for people, and you might be able to help them. Right? If you're looking to cut costs, there might be another startup that is able to provide you the same software, the same tool at a lower cost, and you can help them as well. So I think leverage the community more. And I think like the big lesson that I have, or the takeaway that I have from this event, is really that for a startup, whether you're doing well or you're not doing as well, the state of hustle never ends. And you never know when there's a shock to the ecosystem, and you need to, bring that skill out again. And so I think you just always have to keep hustling, and that's just the state of affairs until you are cash flow positive.
Yeah, I think that is important. We do need to remember that we're not in this alone. The startup community, the VC community, we're all trying to figure this out, and hopefully we're all going to come out of it a lot stronger. Hey guys, listen, I would love to keep talking with you for 2 or 3 more hours. But I think we've already had you here for longer than you offered. So I'm afraid we're going to have to wrap things up now. So thanks for being a part of this session and sharing your thoughts. I really appreciate it.
Thank you.
Thank you. Yeah.
And this is where I would normally ask for a big round of applause for all of our fantastic speakers here, but being online, it makes things a little strange. So I don't know, for the audience, please clap anyway, or just from your heart, let's give all our presenters here a big thank you. Oh, and hey, before I let you go, I want to let you know that we're going to be sending out an email with a survey asking for your ideas and your opinions about today's events. Please take the time to fill it out and let us know what you think. Google for Startups would like to do a lot more of these events, and hearing from you helps us make sure that we're really delivering value. So, okay, thank you again for coming, and I hope to see you again very soon.